Hello everyone, Jerry D'Ambrosio here with VectorVest. Thank you for watching. Don't forget at any point during the video to like, share, and comment. I read your comments last week, really appreciate it, glad you enjoyed it. So last week we talked about one of VectorVest's proprietary indicators called Comfort Index. We are working with the same S&P 500 watch list that we did last week. Now you can do this exercise on any list of stocks within the VectorVest program just with a click of the mouse. So last week we talked about CI and we ranked the list of 504 companies in the S&P 500 by Comfort Index. Today we're going to talk about relative safety, or RS. And with one click of the mouse, we can force rank that list of 504 companies by our relative safety score, by our relative safety indicator. RS, just like Comfort Index, is on a 0 to 2 scale. Above 1 is favorable, below 1 is unfavorable. The higher above 1, the better. Okay, so relative safety is an indicator of risk. Now you don't hear too many talking heads on CNBC or various other places talking about safety, stock safety. I think it's a little overlooked, and I think that every investor needs to assess his or her own personal risk tolerance before even getting onto the stock level. So how much money do we have to invest? How much are we willing to lose? So everybody is different. Every trader, every investor is different. This is our hard-earned money that we're talking about. So, capital preservation should be key. We don't want to lose it all. We, of course, want to grow it. But in the process, we have to make sure that we are aware of, now the individual stock safety rating or, probability of us losing money and how much money might we lose. That's really what risk is, the likelihood or the probability of me losing money on this investment, and what is my max pain? How much money can I lose on that investment? So here we are sorted by relative safety. With one click, just sort by relative safety. You can see, some of the big boys at the top. So our highest relative safety score is at 1.46, and you have United Health Group at the top, Anthem, Vertec, Regeneron, Advanced Micro, Molina Healthcare, you got Tyson Foods, Adobe, AutoZone, Costco, Progressive, and so on. There's Salesforce, there's Meta. So these are what we consider the safest stocks in the S&P 500. So what goes into safety? What goes into our relative safety score? So what you can do with any list of stocks, if you just simply right-clicked on the top stock, you can see this huge drop-down menu. There's a lot of options here. We're going to go right up to the top right here that says View Full Stock Analysis Report. So in a stock analysis report, let me pull this over, we have some information here. Last week, I suggested that you folks request a free VectorVest stock analysis report when I talked about CI and how easy it is to find those stocks that outperform the overall market, no matter what the market's doing. Those smooth, high-flying, kind of persistent growing stocks very easily with Comfort Index. So the stock analysis report has some information at the top. We're going to scroll down. I'm going to get to a lot of this information in future videos, but you could see the recommendation or the rating of the stock, the current value, and I'm going to stop here at safety, relative safety. You can see that it is considered excellent with this particular stock, United Health Group. Its relative safety rating is considered excellent. So it says RS is an indicator of risk. UNH has an RS of 1.46, which is considered excellent on his scale of 0 to 2. RS is computed from an analysis of the consistency and predictability of a company's financial performance, essentially their earnings performance. That's a big part of our relative safety indicator, earnings. How well does the company consistently and predictably meet or beat earnings expectations? Every quarter, what are we doing, right? We're on the edge of our seats. Companies in our portfolio, they're going to report earnings. And if a company does not meet expectations, analyst expectations, what happens a lot of times to the price of that stock, right? Could fall double digits and just, really kind of blow up your portfolio if that happens. Well, these stocks are unlikely for that to happen. Why? Because if they have a high relative safety score, that means that in the past, they have done a great job of consistently meeting or beating analyst expectations. They rarely miss. We'll look at some charts here in a moment, and I'll show you what you really want to look for in terms of our earnings per share overall pattern. That's one of the factors, one of the indicators, I guess you would say, in our relative safety score. So consistency and predictability of a company's financial performance is a big part of relative safety. Debt to equity ratio. Low debt to equity ratio will generally produce high relative safety stocks. If a company has a hard time growing earnings and really turning a profit, a lot of times it has to do with a lot of debt, right? Companies do take on a lot of debt for the tax purposes, but sometimes they can overdo things. And, a lot of people value companies in terms of free cash flow. Well, company can have all the cash on hand, but if they're, paying back too much debt and not able to use that cash to grow their company and grow their earnings, they'll be in big trouble. So low debt to equity ratio is something that is included here in our relative safety indicator. Sales volume. Company has to have revenue. Company has to have good sales. They have to grow those sales, year in and year out. Business longevity. It's no surprise that the longer a company's been in business, generally the safer the investment. Now, just looking at business longevity alone isn't quite enough, right? So we want to use these other indicators here, but companies that have been around for a while generally do that, right? They generally are able to turn a profit, grow their money. A lot of these companies, high relative safety companies, also pay dividends. Most of them do. And if they do, what they have to make sure of is that they maintain or grow that dividend. If a company cuts its dividend, that's really a black eye for a company, and they'll be in big trouble there if they start to cut dividends. Once you declare, you have to maintain or grow that dividend, for your shareholders. So the more a company is able to do all of these things combined here will give us our high relative safety scores. Okay, so those are just a few of the things that are used or included and assessed in our relative safety score. Okay, and what I'm going to do now is I'm going to graph all of these. We'll take a look at some charts here. Here's UNH. I'm going to open up our graph panel here. Just put earnings per share on. Let me make it an area so you guys can see it a little bit better. And what we're going to do, not look at the last year. We're going to look at all the data that we have on each of the stocks in this list. So I'm going to go to the top here, and we're going to go weekly. We'll just look at weekly data, and we'll look at all data. Okay, so here's United Health Group. I'll talk about earnings per share, our earnings per share indicator. It is a little different than some of the other numbers and indicator or earnings per share figures that you'll get other places. But essentially, this is what we want to see. When we graph earnings per share, this is, again, the EPS of the company. Ours is a forward-looking earnings per share, but you want to see this type of pattern. We're looking at 27 years worth of data. There haven't been many times where UNH has failed to meet or exceed the street's expectations. And look at this long-term price history. These are not risky investments. United Health Group is not a risky investment. It's in the healthcare industry, and the healthcare industry in this country particularly isn't going anywhere. We're not necessarily the healthiest. So industry's not going anywhere. United Health Group, they're the big boy. One of the big boys in that industry group. And looking at that earnings per share pattern, that's what you want to see, bottom left to upper right. Earnings is the engine that drives a stock's price higher and higher. So I'm going to flip through these rather quickly and just show you the same type of not only price action. Again, this is about 27 years or so. Actually, 2001 is when we first started tracking Anthem. But look at the long-term price performance, and the long-term earnings per share performance here with all the ones that I'm going to look at. Here's Regeneron. Here's Advanced Micro, okay? Molina. For the most part, this is what we're seeing, right? Long-term, tremendous price performance, long-term, consistent, predictable earnings. Here's Costco, Consumer Staples, Progressive. I'm going to flip through them. So these are the types of stocks that are suitable for your retirement portfolio. These should be your core holdings. Do they have the ability to move up and down in price really quickly? Not really. High relative safety stocks are primarily to preserve capital. Again, ideally suited for your retirement portfolio. So a few of the other things, let me show you guys a couple of things you can do here. Add parameter. If I go to dividend analysis and just plot our dividend here, I'll change it to an area as well. Let's go back up to the top. So here is our dividend number. It's currently at 5.8, $5.08. That's an annualized dividend. But look, once United Health Group declared their dividend back in 2010, they've only grown it. They've only increased it. They've never cut it. Look at that earnings per share performance. These are retirement stocks. Once Anthem declared their dividend back in 2011, you could see it was 0 for a while. They didn't pay a dividend. They started to in 2011. They've only grown their dividend. Okay, Vertec doesn't pay a dividend. Neither does Regeneron. Neither does Advanced Micro, Molina. Look at this one, Northrop Grumman. Northrop Grumman, Aerospace and Defense. They declared their dividend back in 2004. They've only grown it. So this is a huge part, a big part of the relative safety, is if once a company declares their dividend, if they consistently or routinely cut that dividend, that doesn't bode well in terms of a higher relative safety score. So all of these things are considered. You can also plot sales. I talked about how sales is a factor. Okay, sales is a factor in relative safety. Look at that. Look at the sales here. Here's Tyson. Here's Adobe, AutoZone, Costco. So the more a company is able to grow their sales and in turn grow their earnings, after interest, taxes, depreciation, and amortization, once they pay all their debt, what is their EPS looking like? So if I can just continue to go through them, and what I want everybody to understand is how easy that was for me to find those companies within the VectorVest program. With one click of the mouse, you're getting the information that you're looking for. If you had to go through balance sheets and companies' financial records to kind of put all this stuff together yourself, I know there are other services out there that do that, but if you were having to do that yourself, you can imagine you'd make mistakes. It would just take too long. You don't want to have to go through that. VectorVest is a service that gives you all of the answers. You're looking for how risky or how safe a future investment is or might be. With one click of the mouse on any list of stocks within the VectorVest program, you can get those answers just simply sorting by that relative safety score. So thank you, folks, for joining me. Again, this is another video in a series. Not sure what indicator we'll talk about next, but we'll stick with the VectorVest proprietary indicators. We covered CI and relative safety so far. And I hope you're enjoying it. Again, don't forget to share, like, and comment on the video.